What's up, guys? I'm Nobody Special, and we have a special guest is with us this morning. We have Ganapathi is with us. She is the founder and CEO of Unicus Research. She's got some very interesting insight to share with us about consumer credit, student loans, buy now, pay later, auto loan delinquencies, all things that say there are some bad things on the horizon for the U.S. consumer. Lox, thank you so much for joining us today, and welcome.
Thank you so much for having me, and thanks for being flexible with the time frame. Yes, the consumers are entering into a period of credit scarcity instead of saying credit crunch, credit scarcity. So thank you for having me over here.
It's my pleasure. Thank you for making the time. I know your schedule is tight. Now, real quick, before we get into the consumer credit and some of the warning signs that are flashing, I wonder if you might take a minute to talk to us about Unicus Research, about what your firm does, maybe what your firm doesn't do, and then we can get into what your research has actually found.
Thank you. Unicus we started Unicus in 2020. The goal of the firm is to provide actionable, in detailed primary research, fundamental research and analysis, qualitative analysis to institutional client base. And we have been doing that since 2020. And we only do short investment ideas. And we started off with recommending EVs that became public via SPACs as a short. Think of Canoe, Fisker, Faraday Future. And then we shifted to solar, like think about Solar Edge. We recommended at 329 as an entry price for short, and covered it around 50 and some at 14. We do not manage money at this point. We do provide detailed analysis and research and guidance to our institutional client base. So over the period of past 2 years, we have been speaking with all the auto dealers and wholesalers, auction houses, and people who deal with the consumers day in and day out to understand the auto dealerships, which is a very complicated network, and to understand the challenges that are currently being faced by the consumers. And as we getting into the second quarter of 2025, the data is showing us that subprime consumers are the ones who are going to be really affected and impacted, and sometimes prime consumers as well. We also have a newsletter. We don't cover our ideas in there. It's Contrarian Unicus at Substack, but our website is unicusresearch.com if you're interested to know what we do on a day-to-day basis.
And by the way, we will put links to both that Substack and the Unicus website down below in the description, so you guys can check that one out if you want. So a pretty interesting origin story. In 2020, you start your firm with short theses on EVs and solars. And, that's at the height of the SPAC phenomenon where people were just writing blank checks for a stock with no idea what they were actually getting. A lot of that went into EVs. A lot of that went into solars. We had a lot of government money was just being shoveled at these companies. So that was a very, we'll say, gutsy contrarian bet. And it really paid off for you, I would imagine, because we watched these SPACs just drop like flies over the last 2 years.
Yeah, it's interesting you say it's gutsy, and it is, because you will see a lot of people from Wall Street come out and put out bull theses, and all of these stocks, Fisker, CEO, bankrupted the company once, and then he started via SPAC the second time, and he bankrupted it again. And the challenge is to have that quote unquote gutsy calls is we spoke with the battery systems engineer who used to work at QuantumScape, because we are not engineers, and we try to understand the nuances of the batteries that are in the EVs. And the concept is simple. If you have a product and you're bringing it to the market, can you scale it? And can you scale it cost efficiently? And if the answer is no to both of that, then you have a problem with your business model. And that's the case with Fisker, Faraday Future, Canoe. Yes, they all had a great idea of how things are going to be in the future. But if the idea is not feasible economically and scalable, then it's a problem. So that was our take.
All right. So in your introduction, then you kind of hinted at one of the topics that I wanted to talk about today was autos. And you mentioned, especially on the phone call we had the other day, some very interesting research that you and your firm have come up with surrounding auto and auto finance. You mentioned floor plan loans and some inventory problems that might be breeding out there. So could you talk to us a little bit about what you have found in the auto space as it pertains to consumer finance?
Auto space is a very, very tightly controlled, complex structure. When I say tightly controlled, the data are not easily available. There are two big firms, Cox Automotive and Mannheim, and the data published by them from our research and point of view is very controlled and calibrated on how it will affect the overall sector. So we usually do not go by those data because that does not reflect what's actually happening in the market as we speak. So we reached out to the dealers, mom and pop dealers, and the dealers that are under the huge banner of publicly traded companies, which I don't want to talk about here. And we also speak with wholesalers. And over the few years, we created a rapport with a few wholesalers who have dealings with big banks that are repoing the cars, who have dealings with big companies that are buying and selling the cars on a regular basis. So these sources of ours will have the nuances of what's actually happening on the ground. So that's where we gathered the information. And around 2022, 2022, we were talking about the concept called negative equity. And when we started sharing this with our clients, it was like, no one has heard about that in the mainstream media. So we have to explain the concept. Negative equity is if you buy a car, and now everybody is talking about it. So if you buy a car and you have a loan for 2 years or 5 years auto loan, and you're paying it, and you bought a car at, say, $30,000, and you're paying the loan with whatever interest. Let's not get into the nuances, but within year 2, you wanted to trade in your car. So when you're trading in your car, you already have the loan that you took out the first time, but the value of the car is no longer 40,000 for which you took the loan in, and the value of the car went down, but you still are in the hook for paying the loan. And when you wanted to trade in, you have to roll over that loan, and that becomes a problem, especially if your credit is not up to par, shall we say. So, and that's when we realized the dealers in the mom and pop stores started to tell us about how consumers are no longer able to apply for a loan. So this takes us back to 2020 when COVID started. There are a huge wave of stimulus packages that are just flooded into the market by the government, just for whatever reasons. They don't want the economy to fail, so you flood the market with government subsidies to the consumers. So this increased the credit availability of the consumers. So they have more money, and some of the consumers paid back their debt, which boosted their credit score. Now, it's a huge challenge. So let me take a step back and say there are roughly 10 to 11% of the total population are credit invisible. So what that means is they have never applied for credit. They don't have credit. They don't use credit cards for whatever those reasons are. The remainder 89% of the population, of that, around 30 to 35 or 40%, roughly, are subprime. The rest are prime. So now we have that numbers allocated. So the consumers who are in negative equity, even though we don't have the clear-cut data, there is a theory that they might belong to the 30 to 35% of the subprime population. And then we got deeper into it and realized those 30 to 35 subprime of the total 89% of the credit visible population is they are the one who uses a lot of buy now, pay later. And that's the same population, the subprime population, have been enjoying the benefit, or the privilege, so to speak, of forbearance plan introduced in and around 2020 because of COVID, for student loan, for mortgages, for credit cards, and for auto loans. And so forbearance is to simplify that, is you can kick the can down the road until you are able to pay back all your loans. Forbearance does not mean that you can forego the interest that you owe during that period. AKA, if you're kicking the can down the road from 2020 to 2024 or 2025, which means all the interest that's been accrued from 2020 until now, you got to pay it back. So what it's doing is it's impacting consumers' credit scores. BNPL started around the same time when the forbearance started, when the stimulus started. Affirm, Securitized reported this morning. They reported great numbers. Affirm is supposed to report after the close. So all these companies capture the market of the consumers who are subprime. So what they do is you can buy a purse and then you can divide the amount for 4 equal installments without interest. After that, it will start the interest. Now, shifting to how it has not affected the credit score. You asked me a very good question prior to the show. How do you know that these subprime consumers are prime consumers, or subprime and prime? Which is an interesting question, because in 2020, when everybody kicked the can down the road, credit bureaus everybody stopped reporting consumer credit to the credit bureaus. So the subsidy came in, boosted the subprime credit scores, subprime consumers' credit score, and pushed them into near prime or prime. They have nothing to pay for. Forbearance for auto loan, forbearance for credit card, forbearance for mortgages, and everything is student loan. So they didn't have anything to pay for. So they used the money to spend to pay down the debt, to boost their credit score. And that happened from 2020 to 2023, 2024. And now, during the fourth quarter of 2024 and first quarter of 2025, the current administration came out and said the student loan resumption is starting, and we are going to garnish wages late summer. And that impacted a lot of consumers' credit scores, because it had, for prime consumers, the credit score dropped at least 170 points, and even for the subprime. And around April 2025, there was another wave of hit to the consumers, especially the subprime consumers, is that the buy now pay later, like Affirm and Securitized, mentioned that they will start reporting consumer credit usage of BNPL to the credit agencies. So people who are using Affirm to subsidize groceries, they are using Affirm and Securitized to subsidize their day-to-day expenses. Their credit has been cut. So consumers have no money at this point.
Lux, there is so much to unpack there. I don't know where to
Sorry,
start.
I went on and on, but
No, that was fantastic. My problem is I need to distill that down into the next question. And well, let me just start with this thing you mentioned on the phone the other day, because I think it summarizes what you just described. You mentioned while we were talking, you said credit scores are no longer credible.
yes.
And that's interesting because both the word credit and credible derive their meaning from the Latin credere, which is believe or trust. And so if you're saying credit scores, how we measure trust is not credible, not trustworthy, well, then what the hell are we doing here? How are banks, how are institutions measuring risk if they're using this data point, which for all the extend and pretend reasons out that you just listed very well, I mean, where does this leave our financial system? What does this mean for the risk to the lenders then?
It is a very scary scenario, and all these debt, so this shifts to ABS market. So what about banks? That was your question. So the banks, I would not name banks. There are a few banks, regional banks, that we are recommending as a short. So on that note, banks are kicking the can down the road. According to our several sources, banks are begging the consumers to not default on their auto loan. They are begging the consumers to not default on their credit card. We have heard and we have corroborated more than 2-3 times with multiple sources, and banks are pretty much saying, so let's take auto loan. So consumers, the quality of the cars have deteriorated since 2020, right? So the cars that are pre-COVID have a lot more mileage, no pun intended, for the quality, with respect to the quality of how the cars are made. Post 2020, the quality has been deteriorating, and it shows. So consumers who leased or bought new cars or used cars, the quality is so bad that a few consumers mentioned to us and the dealers that you buy a used car for $15,000 or $20,000, and you had the transmission break in the middle of the road, and it cost twice as much, like $3,000 or $4,000 or whatever it is, the price that they are making up these days. Please don't quote me that Lux said the transmission cost $3,000. I'm just throwing random numbers. So the numbers are so high that the consumers are coming out and saying, calling the banks and said, here's the car key, please send a tow truck and take my car. I don't care. I don't have the money to repair the car that I just bought. And the banks are saying, what can I do so you can keep the car? And the consumers are like, okay, it's $500 per month for me to pay the loan. Even if I spend money fixing the car, I can't pay $500. The banks rebut and said, how much can you pay? If the consumers say, I can only afford $100 or $150 a month to pay back my auto loan if I were to fix this car and use it, the bank reevaluates the loan. If it's for 24 months, they are extending the loan for these consumers to 84 months, 94 months. I'm not joking. So the payment can come down to whatever the amount that the consumers can pay at that moment.
I think a lot of people may be glancing over what you just said a little bit with the numbers there. So I really want to drive that home. What you just described, it's almost like it's reminiscent of the zombie homeowners following the GFC. I mean, zombie car owners apparently are a thing now.
Yeah.
And I've seen this. I've had a guy named Tom Palella. He runs a car broker named Car Concierge Plus. He buys cars for people. And Tom has talked about some instances where one of his clients didn't want the truck anymore, and he had to write a check for $30,000 to get rid of the truck. And that's that negative equity that you described. So somebody who doesn't have the $30,000 and doesn't care about their credit score is just saying, take my car.
Yeah.
And the banks here are in such a weak position. That's important here. The weakness in the banks, that the banks are saying, oh no, please don't. I don't want the car back. What can you pay? And then you're saying 94 months extending a car loan to, I mean, we might as well be taking out 30-year mortgages on these things now.
84 to 94 months. Yes.
I mean, and are these used cars we're talking 84-month loans on? Possibly?
Well, the used cars, new cars is a gray area at this point. I will give you an overview. I wanted to get into the banks. So OEMs manufacture a lot of cars. I have the data in my report, but I haven't pulled up yet. But the cars, the OEMs have manufactured a lot of cars during the COVID to meet the demand. And then there is a point currently where there is an oversupply of cars. Nissan is a classic example. And there is an oversupply of cars, but for some reason, maybe our lifestyle in this economy, there needs to be a new car every year, right? So you have a 2025 model coming out around 2024 fourth quarter. And you will have a 2026 model coming out in 2025, end of third quarter, beginning of fourth quarter. But there is no demand. You still have a lot of cars sitting on dealership lots from 2023, brand new cars, 2024, 2025, and you have new cars coming in. So there are a few OEMs that shut down the manufacturing facility so they can deal with the oversupply, but others, they are still manufacturing cars like it's going out of style. And we heard through credible sources over the years that to battle this, some dealerships are using the new cars as an inventory to the old used car. Now that used car markets are in demand, they are using the new car and morphing it into used car and selling it as used car because used cars are in demand. So the car industry is so complex that there are dealerships who used to beg the OEMs not to send new cars. And this happened during the mid 2024, and you won't read this in the mainstream media, and that's a problem. So around mid 2024, mom and pop dealers and other dealers are going to the OEMs and saying, don't send us new cars. The OEMs, as like a toddler, as a weird way to throw tantrum. If you don't buy this new inventory from us, we won't give you special discounts. We won't give you dealership financing. We won't give you dealership discounts. So they blackball the dealers. So there is a lot of politics going on. But to summarize this, banks, to shift to the banks provide floor plan loans to dealers. And what that means is all the cars, you drive around to a dealership, you see all the cars parked over there. the dealership does not own them outright. They take out a floor plan loan from whatever banks, group of banks or one bank, and use that loan to show the car. And when the consumer buys a car, then they will use that money to pay back a portion of the floor plan loans. This is as simple as I can explain. And some of the dealerships, as we entered into 2025, were not able to pay the floor plan loans. And that's because their cars are not selling. So they are calling. So you have one side where the consumers are calling the banks and saying, hey, take my car. I don't have money to pay for it. And the banks are kicking the can down the road. And the other side of this coin is where the dealers are going to the banks and saying, I can't pay the floor plan. I don't have the sales. You have to give me more discounts so I can pass it on to the clients. So one specific bank or a couple of banks went to the local or going to the local mom and pop dealerships and saying, hand over the key to me. You haven't paid your floor plan loans and I'm shutting you down. And the dealers were happy to just hand over the key for all the cars, and there is a dealer repossession. Now, why, you can ask me, why these banks are not going down, Lakshmi? The question is, the banks have to take it back to the wholesalers or auction houses and sell them there, and they will take a loss, and then they have to show the loss in their books. Now, all the banks are holding up pretty good because they're paying up dividend and the ABS market is happy for their dividend and shareholders are happy. If one bank starts to show weakness, every single regional banks that has exposure to commercial real estate, exposure to auto loans will fold. So banks are not showing the report cars in their books. They are not selling them they are not taking them to the auction houses to sell them. So they're just having the inventory, I don't know, wherever they wanted to park it.
And once again, I feel like the profundity of that answer might get lost on some people. And again, a lot to unpack. So we are seeing an oversupply of cars.
Yes.
That are not selling, a lack of demand. People can't afford them.
Yes.
Those two scenarios, we should be seeing car prices heading lower, but clearly we're not. Cars are getting more expensive. Tariffs won't help. That's a whole other story. And the reason we're not seeing this supply come to market is because in some cases, these banks are repoing entire dealerships worth of inventory. But in the classic game of extend and pretend and the floor is price discovery, they're not selling these cars. They're just sitting on them, parking them somewhere, to use the pun. Now, we're not talking about homes where you just sit on it and you wait for the market to recover and then you foreclose or then you sell it. We're talking about a rapidly depreciating asset, a vehicle here.
Yeah.
And so basically what we're saying here is there's no price discovery, not even in the car market.
No.
And the banks are hiding the losses. And the reason they won't do it is because the second they sell these vehicles, they have to admit that loss, acknowledge it on their books, and take the hit to their earnings. So then even these bank earnings aren't real then.
To that point, banks, if you see, they technically should have higher provision for credit losses, and they are not. Because that, in a weird way, shows the shareholders everything is fine when it's not. The more we started to realize through the primary research, it feels like the market is just running on fumes, and there are very few people are figuring it out, or there are a lot of people who knows what's going on, but trying to pretend not to know it, because once they accept the reality, it's hard. Consumers, especially subprime consumers, are the one going to take a hit. And it's very concerning from our point of view that The second the student loan resumption started, the garnishments are expected to start late summer. Social Security garnishments, wage garnishments, and then you have BNPL that consumers, I don't know, I shared with you a chart that shows where the consumers are spending money. So the consumers will have to take a hit. So are you going to pay your mortgage? Are you going to pay your student loan? Are you going to pay your auto loan? Are you going to pay for your food? Are you going to pay for your groceries? Are you going to stop eating outside? Are you going to use BNPL? But Affirm, few customers came out and said in Reddit forum, Affirm removed the pay in full installment option for some customers. And I think the other chart shows it a lot clearer. The 2022 version with the flow chart. And this is it's funny because you and I were discussing the other day, and you mentioned on my post on Twitter that you do not buy the Affirm's 2% delinquencies, which is hilarious because you are absolutely right. Affirm went straight up and defending its status with against the CFPB assessment of what they said was one of the most significant findings from CFPB's report is that BNPL default rates are substantially lower than the credit cards. And Affirm said it nearly 3/4 of its customer base are near prime, prime, or super prime, compared to 35% mentioned in the CFPB report. Now, I do not buy this Kool-Aid because 71% of Affirm's consumer base are not near prime, are not prime, or not super prime. They said the CFPB report of 35% of Affirm's customer base is subprime. Affirm is saying it's wrong. So imagine the amount of misinformation, incorrect data going around the financial world. Affirm contradicts with CFPB. CFPB contradicts with Affirm. Who are you going to believe? Who the customers are going to believe? The market is believing what it wants to believe, and the market rallies. At the end of the day, and I don't know if you have that chart, the consumers cannot afford everyday groceries. Inflations are high. You're using BNPL to do takeout, using BNPL to do buy designer bags. I don't know if you have seen it, but Gucci started to collaborate with Affirm for buy now, pay later. I am speechless.
Not just Gucci. I mean, we're seeing DoorDash is now partnering with these buy now, pay later. So, you can break up your lunch into 4 convenient payments. I mean, there's so much what stage going on here that it really defies logic. And, I first caught wind of the Affirm story. It was January of last year when they were reporting their 2% and change delinquencies.
Yeah.
And it just didn't pass the sniff test. You're talking about unsecured credit. There's nothing to repossess.
No.
You're talking about average borrowers in the subprime range. And you're talking about people who are already delinquent at elevated rates for autos and for mortgages and for other credit card debt. So why would somebody pay an unsecured loan that doesn't get reported to their credit agency, who is not paying the debt where they can repo the car, and that does get reported to the credit agency? There was just no logic there. And I tell you, there was an interview that Affirm CEO Max Levchin gave on Bloomberg. This was a couple of months ago now, but man, would I love to see a body language expert analyze Max Levchin's mannerisms and facial expressions when he was trying to explain his low delinquencies and how, well, we just aren't seeing it. again, it doesn't pass the simple sniff test. It just seems too good to be true. And then, as you pointed out in some of your recent tweets, all of a sudden they're reporting it to the credit agencies.
That's
And
when
magically, all of a sudden, they're starting to reject people.
yeah.
Well, gee, why are you suddenly rejecting people now that we can see under the hood? Maybe it's because it was never this rosy picture that you were painting.
And the point is, Affirm and few other BNPL, they are allowing consumers to use their credit card to pay the BNPL.
So take out new debt, more expensive debt to pay off your old debt, but this one is at a higher interest rate. And didn't the CFPB, didn't they try to ban that about a year or two ago?
Well, that's the interesting thing about regulating agencies. We are apolitical, so regulating agencies' job is to regulate and protect the consumers. Regulating agencies can no longer able to freely do their jobs for whatever reasons and whatever changes in the policies. So because of that, no one cares about the regulation and regulating agencies. So you can say this is a fraud, payday loan lenders, this is scamming the consumers. And CARS Act, CARS, CARS Act, I think it died. The CARS Act was there to protect the consumers. It died. So consumers are completely not protected and they are drowning in debt and they're just going to walk out. They're going to say, I'm not going to pay. There are few people that I know have student loan debt. And I was having a conversation with them. I said, hey, remember, these are well-off people. They are in the near prime and prime categories. Said, hey, you've been using forbearance for so long, but you could have easily paid. Their response just was, oh, I don't think I will ever pay my student loan. Why should I? I can keep applying for forbearance and someday it will just go away. So people are not interested to pay back the loans. And in a weird way, I think the consumers are holding the banks as a hostage, which is interesting because once the bank started to show a realistic picture of what's happening, then it won't be pretty. The market hasn't factored any of it.
And one of the things that, as part of my nuclear training and my background, I'm always defaulting to the worst possible outcome as my base case. That's just, we're trained that way to protect against catastrophe. And so when I first started studying buy now, pay later last year, I said, okay, what's the worst thing imaginable? I said, well, the worst thing imaginable is they would bundle this crap up into a bond and sell it to grandma's pension fund. And I was just kind of like joking to myself, ha ha.
Well, they are.
What they're doing.
They are doing it. And they are doing it. We are tracking. It's funny you say that. We were tracking ABS markets for credit cards, mortgage-backed securities. All the fancy things in 2007 that they swore that they would never do it. It's happening. It's happening with BNPL. And they're in auto ABS month over month. I think the prime delinquencies on auto ABS are increasing, and so are the subprime. ABS market is sending warning, and nobody is listening.
I was going to say, I posted a screenshot of this in response to one of your tweets recently, that Fitch just released a rating on one of these Affirm asset securitization trusts, one of these bonds made up of buy now, pay later loans. And they included a base case default rate of 7.5% on those loans. So the ratings agencies are finally looking, and their base case default rate is triple what Affirm is telling us in their earnings comments. They really are. Somebody here is either lying or very wrong.
I did not check that yet because there's so much data coming in, but thank you for pointing it out, because 7% is their base case.
Yeah, base. And I mean, correct me if I'm wrong. Isn't 8% the level where most asset securitizations start to fail?
Yes.
So their base case is 0.5% below failure. Let's just stamp that thing AAA and sell it to grandma. Sure. Why not?
It's what I feel, what's very concerning and literally keeps me awake at night is the consumers. We go shop just like everybody else, and no one knows what's coming. And it makes me question which data is right. I mean, look at this morning. There was a news that says that, UK is pushing back on trade deals, and it was everywhere. And I looked for the source. I could not find the source. Then I have to retract and delete and say that to maintain our integrity, and I can't find a source to corroborate this. So we are at a point where, do we trust CFPB? Do we trust Affirm? Or we listen to regular people who are getting suffocated by debt, and their credit, the only access for some consumers, the 30% of the subprime group are the same group that are defaulting on student loan. The 30% subprime consumers are the ones who are defaulting on credit cards. The 30% group are the one who is accessing BNPL for the groceries, for everyday gasoline or whatnot. And their credit are getting completely cut ever since the student loan resumption happened, ever since that BNPL started to report it to credit agencies, which is from April 2025. Now, take a step back and think about what's going to happen to the subprime consumers when their wages are getting garnished from late summer. So subprime consumers make anywhere between $50,000 to $65,000 a year. Do the basic math of taking the deductions and everything, and you have your monthly nut, and then you spend it on rent or mortgage, day-to-day expenses, groceries. If you just get into the nitty-gritty of everyday expenses of consumers, they do not have enough credit to keep them going. They are no way going to pay your $300 monthly loan to your auto loans. They are no way going to pay the auto insurance. We haven't even covered yet a number of people who are uninsured have risen since COVID for auto. The insurance prices are going up. This is a total catastrophe that no one is talking about.
You summarize it pretty well there. You take your average consumer, or let's say your average younger consumer, student loan debt. They've been giving mixed messages about forgiveness and forbearance for years. So now their wages are getting garnished now that payments are coming back. Their credit score is dropping by 200 points suddenly. They thought they had a 750 credit score, even though they haven't made a payment on their loan in 5 years. All of a sudden, their credit score goes down. They are being cut off from buy now, pay later, which they've been using to make ends meet for years now, because buy now, pay later all of a sudden has had this epiphany that, now that we have to report to the credit bureaus, we're going to start rejecting people. On top of that, you've got this elephant in the room of tariffs, and higher consumer prices that I think probably will start to hit by late summer in a big way, along with shortages.
It's already hitting. Everything is at least double. We are not rich enough to eat avocado anymore. It's like $2 an avocado. I'm like, I don't want that badly.
And meanwhile, all of this weakness is being hidden from the public eye in the form of these various extend and pretend and forbearance programs, and like you talked about with the autos being hidden. So, with a consumption-based economy, I mean, we're looking at a severe recession here. I mean, isn't that what
depression
with the D word? depression?
A lot of people will disagree, and that is one of the curse of contrarian. Sadly, we see things before it happens. I am not. No one can pinpoint when everything is going to unravel. So I'm not going to pretend that I can pinpoint when it's going to unravel. But what we have been saying is, it would be great if there is a point in time there is a recession. It would be like, you get it over with, and then there is a bullish trend and everybody is fine. It's a prosperous economy. What's happening now is that we have been saying since third quarter of 2024 is stagflation, and that is a nightmare. And that means that it's not the dirty D word, which is depression. It's that we are going to be in a persistent recession or depression. It's not going to happen in from our point of view and from our research is that it's not going to be a point in time where this is going to happen for a year or this is going to happen for 2 quarters. This is going to continue to happen. And that's the problem. You have persistent high prices, tariffs on and tariffs off is not going to. Ships take time to come from China to US. Things take time. You are seeing about, say, for the tariff wars, longshoremen will be unemployed if ships are not coming to the docks. You will see a spike in unemployment, and the unemployment that happened with Doge, and that is yet to catch up. Anything that happens, any decisions in a macro level that's happened, interest rates, tariffs, anything, it's going to take at least 3 months to 6 months lag to trickle down and affect the consumers. So nothing, whatever is happening right now, it's going to have an immediate effect. The lag effect is 3 to 6 months, and it's going to catch up by the end of the year and into the first quarter of next year. And all the policies that administration makes or do not make at a given point in time today will have another ripple effect with its own lag, that is 2 to 3 months. So whatever the administration or policymakers are making policies right now will have a later impact. Resumption of student loan. The garnishments is not happening right away. It's going to happen in late summer. Unemployment is when Federal Reserve Chairman yesterday, when he was talking about I am not seeing things in the data, which is a fancy way of saying things are happening. It is in the process of getting into the actual numbers. And you won't see those numbers until 3 to 6 months. That's a problem. And that's why you're not seeing things happening right away. And that is going to be a huge problem for consumers.
Well, Lax, I want to thank you so much for taking the time to share some of your research with us. Some pretty profound stuff here. I'll give you the last word if you want to plug your Substack one more time or talk again about Unicus. And I don't know, is there anything the average person can do to prepare or at least mitigate some of this stuff? I realize that's kind of like a duck and cover scenario when a nuke is going off, but
just don't get new credit. I mean, it's hard to say that, to be completely candid, because these are regular customers. These everybody have to eat. Don't splurge, just have some for rainy day. It's a very, very poetic advice, but it's not practical. You can't tell a customers who needs to eat, who needs to feed his or her family, to say, save money, because we are in such a messy situation economically, and don't spend on things that you don't need. And that's what we are doing. We are live in a community where we swap things here where we live, And I don't know if there is any facility like that in the rest of the country, but consumers are in serious trouble. And you will see most people walking out saying, I don't want my cars. And we will see the cascading effect happening with the regional banks. Um, I hope I'm not taking too much of the time, but one of the regional banks that I can name, uh, uh, they have a huge exposure to a commercial real estate client, and they just in their second quarter, first quarter earnings, moved that client millions and millions of dollars to non-performing loans. We are in for a bumpy ride, but you might not see this in a news. And I'm not a doomsday kind of person, but I am a very realistic person in a pragmatic way. No matter how you see it, things are not going to go well for a while.
Well, Lux, I can tell you, I very much am a doomer. I wear that proudly on my sleeve in invisible ink. And when the doomers and the realists are on the same page, that's when it's time to start paying attention.
True.
And so, very wise words. Have the wisdom to know the difference between a need and a want. Have the discipline to avoid the want category during hard times. I mean, other than that, there's really not a lot the average person can do, is there?
No, but if anybody has any questions, I'm happy to share our take. And for to the regular consumers, feel free to reach me through Twitter, or feel free to reach me through email, laks@unicusresearch.com. And happy to answer any questions or concerns. Happy to share some of the research regarding student loan, so you don't need to go through 1,000 websites to get answers. And if I don't know any answers, I'm happy to direct you to the right place. It's the least we can do.
Well, thank you so much for that, Lex, again, and for your time today. And just a reminder, guys, the links to everything Lex just mentioned, that will be down below in the description. Highly recommend those. Thanks again, Lex, and everybody else. Until next time, live small and dream big.
Thank you so much for having me.